Hey everybody, Jeff Bangerter here. I wanted to go over some new reverse mortgage products that are available. So I'm going to just use a sample here. I've got a female, age 79, using our office address as the address, and my phone number there if you need to get a hold of me, 916-965-1879. I'll get that to you some more in just a moment. I'm going to use a property value of $625,500. I'm going to show you two examples. I'm going to do a small mortgage, $100,000 that we're going to pay off. Then I'm going to come back and do $350,000, so you can see how these different loans react. And so what I want to do is jump right into the loan page and show you the choices that we have. So I am with High Tech Lending. That's my bank that I'm with, mortgage bank. And the HECM 60 fixed product is the fixed offering. This is the federal government's program. The LIBOR 60 is the kind of the product that's been around forever, except for they adjusted it and limited it a little bit how much money you can get. And then the annual LIBOR is new, and this HECM Max 5 is new as well. So I'm going to actually jump to this LIBOR product here. And since this is the kind of the one that's been around forever, and you can see there is the LIBOR, first off I should tell you, stands for London Interbank Offered Rate, and this is the 1 month maturity, so you're going to see this is going to adjust every month. And so that current rate is 0.154. There's an expected rate of 2.71 on this loan. And what you're looking at is a margin of 2.25, and then so the initial rate is 2.404. And by the way, this expected rate here is just one that the government uses based on the 10-year continuously maturing note, and it is just utilized to determine how much money you can get actually. And so it's important, but it's not a rate you're actually going to pay, so you don't need to worry about it from that perspective. So the pie chart here is just showing the entire home value, $625,500, and you can see that there's a line of credit available here of $268,000. We're paying off your mortgage of $100,000. There's insurance to the federal government, $3,128. That is to ensure that if the lender, in this case High Tech Lending, if they were to go out of business, that you're still going to have $268,000 available. It also ensures the lender that if you live too long and you take all this money and the loan becomes worth more than the entire house value of $625,500, that the lender will not lose money. So it ensures both parties on this. So the equity reserve $245, that is for interest to accrue on the loan. So the longer you have it, then we're going to use up part of that equity. And I'll just give you a couple things. I'm going to open the simulator and just show you a couple of things as we go out. I'm going to advance this 10 years. And you can see that this line of credit has grown to $491,000. And so this really, of course, this is all based on a lot of variables. It's what's interest rates, and how much money have you taken out along the way. We're showing your home value increasing at 4%, so it's up to $925,000. So the reality is none of us really know what is going to happen, right? And so this just gives you an idea of what could happen. And so if we look at just some of the different loans that are available, it's kind of easier if I go down to this comparison page, because I could flip back and forth, between all of these loans, and what'll happen is you'll kind of get lost in the graphics and so on. So let me jump to this comparison, and I need to add a couple of products. So this is the fixed rate product. This is what a lot of people think they want, but as I show you, it doesn't work for a lot of people, and I'll kind of explain why. Let me go ahead and add the annual product and this new HECM Max 5 product, and we'll just run through these real quick. So on the fixed rate product, there is no index or margin. It's just a fixed rate, 5.06, so the expected rate is 5.06. The mortgage insurance premium, so the federal government charges you an initial mortgage insurance premium, that is what you see here. And then they also charge you a yearly mortgage insurance premium of 1.25% of the outstanding debt on the home. And so both of those things will get calculated in. Then the cap on the interest rate on the fixed, it's the same. As we jump over to the 1 month LIBOR, you can see that the expected rate I already mentioned there. Here's the MIP, the mortgage insurance premium. And then look at the cap on the interest rate of 12.40. Well, normally you would think, well, my goodness, that's terrible. And they can raise that every month as much, it can go up every month, and then the cap is 10 points above your start rate. So your start rate was the 2.404, so the cap is 12.404. Here's the thing that you have to keep in mind is if you had left all of the money in the line of credit, $268,000, and the interest rate happened to jump up to 12%, you'd be making more than 12% on the line of credit. So just to prove that out, here's the initial rate, 2.40, right? And here's the initial line of credit growth rate. Now, I shouldn't say you're earning interest on that money because we don't have the money. It's equity still left in your house. So this is a growth rate on that account. So we're charging you 2.4, the government's charging you 1.25, but we're growing whatever money you leave in the line of credit at 3.654. Well, if it happened to be 12%, holy cow, your money would be growing really nicely. And so this is not a terrible loan. It's just, what are you trying to accomplish? And so now there's this new loan, this 1 year LIBOR. So it's still the London Interbank offered rate, but it's the 1 year maturity. And so the interest rate's a little bit higher, 2.797, but it's capped at 5 points. So it only goes up to 7.797. And then the 1 month, the HECM Max 5, a new lender created this. And so what this does is it's just like the 1 month LIBOR, except for it's a little bit higher in the long-term costs, I suppose, but it's not much. It's a few $100s more in cost. So it still caps the interest rate out at 5%, so 7.404 on the 1 month LIBOR. So if you don't like this 12, you can say, well, I want to cap it over here at 7, and still have some credit line growth, but it won't be as much if interest rates really climb quite a bit higher. The home value, $625,000 across the board, $625,500. I did that because the maximum lending limit is $625,500. If your home is worth more than $625,500, it's good for you and your heirs, but it will not get you any more money. So if your home's worth $800,000, it would show home value of $800,000, lending limit $625,500, max claim amount $625,500. So if your home's worth more, great. You just cannot get any more money than somebody that has a home worth $625,500. The principal limit now is a calculation based on the expected rate and your age. And I'm using a 79-year-old here, so the principal limit $379,000, $678,000, and across the board, and where there is no set aside, so we don't have to worry about that. Adjusted principal limit would be if there were any set asides, but there are none, so it comes out the same. Then you have that initial mortgage insurance premium that has to come out to pay the federal government. You have the origination fee, which is how the loan officers and the processors and everybody gets paid. We all get paid out of that. And then other costs would be the credit reports, appraisals, and all the normal stuff, title insurance, all the things that you have to do in a regular loan. Remaining principal limit then is just taking those things out and leaving $368,157, and you can see it is a little bit different with this loan here at $367,600. So you're, like I say, a few $100s. It's not a big difference. So if you wanted to go with the 1 month LIBOR with a 5-point cap, you're not giving up much to do that. So we're going to pay off a $100,000 loan in my example here. So that takes us down to an available principal limit of $268 because we had to pay that off, right? So just $100,000 off of that across the board. Funds available at closing. So on the fixed rate loan, you could take $116,000, and in one shot. In fact, that's what we require that you do, is take it, $116,000. On the LIBOR products, the adjustable rate products, that money is also available, or you can take a monthly income of $1,893 a month for the rest of your life. That's what tenure means. So it's not for 10 years, it's tenure, which is a lifetime payment. And or you could take that $116,000 just like you could on the fixed rate the first year, and then the second year, so after the first year, you could come and get another $151,000. So the fixed rate in this situation cuts you out of $151,000. So if you don't have a big debt on the property, the fixed rate product is not going to give you as much money as one of the adjustable rate products, plain and simple. So you have to decide, how important is it to have the access to this additional $151,000 that's available. Now let me go back and change the parameters a little bit. So I'm going to put a big debt on this home of $350,000, just to show you how that changes when we go back to this comparison. So the first thing that I want to draw your attention to is the initial mortgage insurance premium. So it jumped up to $15,000. And so the federal government, it's kind of their way of trying to limit how much money people take from the reverse mortgage. They don't like seeing people come in and take out $355,000 out of a $625,000 house. So they charge you quite a bit more when you take the big lump sums out. Origination fee stays the same, all the other costs stay the same, so your remaining principal limit, $355,000, that's what's available across the board. Again, the lien, $350,000, we're going to pay it off. All the loans will do that. The available principal limit then, what's left for you, is $5,600. Again, a little bit less on this last product. And you may take it, you have to take it on the fixed rate. So you do get all the money on the fixed rate if you have enough, what it's called total mandatory obligations. So if you owe a big enough debt on your home, then the fixed rate product works really well. Or if you want to use the reverse mortgage to do a purchase, then the fixed rate product works really well. But if you don't owe very much on your home and you're trying to access as much money as possible, then one of these adjustable rate loans is really going to work the best for you. The key is to work with somebody that's knowledgeable about it. I've been involved with the reverse mortgage business for years and years. We've done thousands and thousands of reverse mortgages, and certainly we can help you to determine which one is the best product for you. And so I would recommend just give us a call and we'll run this quote for you so that you can see exactly which product would be best for you. So hopefully that made a lot of sense. I know there's a lot of moving parts. Don't let that scare you. The key to the reverse mortgage is, you have equity in your home. Do you want to just leave it to your kids, or do you want to use it? Because ultimately somebody will get the use of it, either you or your heirs. So take a look at the reverse mortgage as an option. Give me a call. 800-451-2351. Again, 800-451-2351. Have a great day.